the halving. So we'll go from roughly 1.9% growth in Bitcoin supply per year down to 0.9%. So we will drop below 1% for the first time. Long-term holders account for, I believe, 15 million of the Bitcoin outstanding, roughly 15 million. Total outstanding right now is 19.5 million, and the total that will ever be outstanding is 21 million. Those long-term holders are not selling. That's what's going on with the price right now. Bitcoin alone is going to be the biggest part of the entire crypto asset ecosystem. Our expectation out in 2030 that it will be a $20 trillion, it will be worth $20 trillion. I have been waiting for this for 50 years, ever since they closed the gold window here in the United States in 1971.
A crucial element in Wood's analysis is the behavior of long-term Bitcoin holders. These investors, who account for approximately 15 million of the 19.5 million Bitcoin currently outstanding, are not selling their holdings. On-chain analytics, performed by Wood's analyst David Coyle, indicate that these holders have not moved their Bitcoin in at least 155 days, suggesting a strong conviction in Bitcoin's future value. This reluctance to sell unless prices spike significantly implies a stable and committed investor base that underpins Bitcoin's value. Wood also touches on the significance of Bitcoin's halving events, where the growth rate of new Bitcoin supply is cut in half. The upcoming halving will reduce the supply growth rate to below 1% per year, a milestone comparable to the long-term supply growth rate of gold. Unlike gold, however, Bitcoin's supply cannot be increased in response to price spikes, creating a unique supply-demand dynamic that has historically been beneficial for its price post-halving. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Bitcoin alone is going to be the biggest part of the entire crypto asset ecosystem. Our expectation out in 2030 that it will be a $20 trillion, it will be worth $20 trillion. Now, how much will ETFs get of that $20 trillion? I don't know, but that already right there is, if you think about it, I mean, it runs circles around SPY, number one, and I believe all of public equities globally, no matter what wrapper they're in, are valued right now at roughly $120 trillion. So when I say 20 trillion by 2030, that's a very big category. All of the ETFs out there right now hold about 3.9%, roughly 4% as of today, of all the Bitcoin outstanding. Now, the really interesting thing about that is if you look at on-chain analytics, which our analyst David Coyle does for us, you'll see that long-term holders account for, I believe, 15 million of the Bitcoin outstanding, roughly 15 million. Total outstanding right now is 19.5 million. And the total that will ever be outstanding is 21 million. Those long-term holders are not selling. That's what's going on with the price right now. And the flows into the ETFs which have taken the friction out of buying Bitcoin and which can be used as collateral for loans, whereas Bitcoin itself cannot, suggest to us that, that added 1.5 million to go in Bitcoin is going to have to cover a lot of investors, institutions, and so forth. In other words, the price will have to go high enough to wrest the supply, some of the supply, out of long-term holder hands. And just to clarify, long-term holders, and again, you can track this on chain, they have not moved their Bitcoin from their wallets in at least 155 days. And when that occurs, the odds that they will move their Bitcoin go down dramatically unless the price spikes dramatically. The halving, so we'll go from roughly 1.9% growth in Bitcoin supply per year down to 0.9%. So we will drop below 1% for the first time. And if you look at the long-term history of gold, very long-term, what you'll find is the average supply growth has been roughly 1%. So now Bitcoin supply growth is dropping below the supply growth of gold. That is a milestone, I would say. And the other difference here is when the gold price spikes, there's usually a mining response and the supply spikes with it. That cannot happen with Bitcoin. So it's quite a different dynamic. So the halving is that milestone. And if you look historically after halvings, it's usually been very good for the Bitcoin price. Now, it doesn't happen right away. I don't know why it doesn't happen right away, but it doesn't. Now that the market's becoming more efficient with ETFs, it might, because think about how many people even know about the halving this time around when they didn't even know what Bitcoin was 4 years ago. They didn't know what it truly was. And if I can just throw one in terms of how we try and describe what this monetary revolution is, and each one of these words is important. The first, global, that's critical. Private, no government oversight. Digital, decentralized, rules-based monetary system in history. It is what my mentor, and many people know Art Laffer for his Laffer curve and fiscal policy and so forth. He's a monetary scholar as well. And he said, I have been waiting for this for 50 years, ever since they closed the gold window here in the United States in 1971.
Wood describes Bitcoin as the first global, private, digital, decentralized, rules-based monetary system in history. This system represents a monumental shift from traditional fiat currencies, which have been plagued by issues like counterparty risk and inflation. She cites the regional bank crisis in the United States in March 2023 as a pivotal moment when Bitcoin demonstrated its strength by rising from $19 to over $40,000, highlighting its role as a risk-off asset in times of financial instability. Wood emphasizes the importance of Bitcoin's low correlation with other assets, which positions it as a valuable addition to institutional portfolios. Despite skepticism from some quarters, such as Vanguard, she argues that Bitcoin's unique characteristics make it a new asset class that cannot be ignored. Institutions that fail to incorporate Bitcoin into their strategies may ultimately lag behind those that do, as Bitcoin's low correlation can enhance returns per unit of risk.
Well, I think something very important happened last year. In March of 23, regional bank crisis here in the United States. Regional banks imploded, some went bankrupt, and Bitcoin exploded. It went from 19,000 to more than 40,000. What did that demonstrate? That demonstrated that Bitcoin does not have counterparty risk like banks do. And so it became a risk-off asset. Before, we had just thought of it as a risk-on asset. When liquidity is flowing, Bitcoin will be one of the prime beneficiaries. But this idea that it is also a risk asset, and as we hope we've shown in our own new asset class white paper, its correlation with other assets is so low that institutions have a fiduciary responsibility from an asset allocation point of view to at least look at it. And if they want to dismiss it, fine. Vanguard did. But what we think that Vanguard is doing is, well, one of two things. Vanguard has never invested in commodities, so it's just treating this like a commodity. For the most part, it hasn't. But we think it's a new asset class, and Vanguard will be depriving its clients of access to a new asset class, which, if continues to be low correlation of returns, what will happen is those using it will see increased returns per unit of risk, and they will outcompete the Vanguard advisors. So, I think there will become, even for the Vanguard ecosystem, a demand pull. It's interesting for me to watch the Fed hold so much power over global markets, whether equity or fixed income. These are human beings, and they're not even following rules. Now, they would say, yes, we are 2% inflation. So maybe this one will end up being better than most. But if you look back in history, and if you look into emerging markets, the history of fiat currencies is atrocious. Even the dollar has lost 99% of its value since the Fed was created in 1913. I don't think that was supposed to be the outcome at that point in time. And you're seeing some nation states. El Salvador is using using Bitcoin as legal tender, or has deemed it legal tender. We think there could be a competitive dynamic in emerging markets in this regard, not only deeming it legal tender, but also putting some into their treasury to benefit from the appreciation that we've seen. And it could become a competitive dynamic too. I know we're much more attracted to looking at opportunities in El Salvador today because of President Bukele's attitude and embracing of Bitcoin and everything technology. He's got enterprise zones, he's inviting AI. So we think this is an innovation movement, and we think there will be regulatory arbitrage around the world, and those countries that treat it more favorably are going to gain share. This is what worried us so much about the SEC here in the United States. It was treating the crypto world like a bunch of criminals, and to some extent still is, as a bit of a poor loser when the courts have ruled that is not your jurisdiction. You just have to say, is an ETF wrapper appropriate for this? But we're having many other people weigh in, academics, to your point about an antidote to some of the mismanagement of monetary policy that we've seen through history.
Wood discusses the contrasting approaches of different countries towards Bitcoin. While the SEC in the United States has been somewhat adversarial, treating the crypto world with suspicion, other nations like El Salvador have embraced Bitcoin as legal tender and are exploring its potential benefits. This regulatory arbitrage could lead to competitive advantages for countries that adopt more favorable policies towards Bitcoin and other cryptocurrencies. Wood concludes by reflecting on the broader implications of Bitcoin and blockchain technology. She sees it as part of a larger innovation movement that includes advancements in AI and other technologies. Countries and institutions that recognize and embrace these innovations are likely to gain a competitive edge in the global economy. Please like and subscribe my channel.